Hello everyone, good day. Welcome to another session on the fundamentals of accounting. And today's topic is about general journal, general ledger, and trial balance. So before we go to the discussion, let's first check the learning outcomes of this session. First, to differentiate the three types of book of accounts. Second, describe the chart of account and explain its purpose. Third, apply the concept of debit and credit in journalizing. Fourth, demonstrate how to post the journal entries to the appropriate general ledgers. And lastly, to discuss the trial balance and its relationship with general ledger. So let's begin with a recap from our topic in Chapter 2, starting with the accounting elements. This is composed of the three basic elements and permanent accounts, which are the assets, liabilities, and owner's equity. And then temporary accounts, which are income and expense. So the primary characteristics of asset is again, it is what you own, it is resulting from past events, and expected economic inflow or future economic benefits. While liabilities, on the other hand, are what you owe or are present obligation. Still results from past event and expected outflow of economic resources to settle the liabilities. Owner's equity are the residual interest. So this is a result of your assets minus liabilities. Income are those money that are received in exchange of labor or sale of goods. And lastly, expense are those costs that the business incur in running the business operation. We also discussed previously the accounting equation, which is assets equals liabilities plus equity. Next is the accounting cycle. Previous discussion, the 10 steps in the accounting cycle was already discussed. However, in this illustration, you can see here that we have grouped each steps from 1 up to 10 and incorporated them into the phase of accounting that it belongs. So we were already done with step 1 during our previous class discussion. And now, we will proceed to steps 2, 3, and 4. But before we start journalizing transactions, let's discuss first about the double entry bookkeeping system. This is a method of bookkeeping that relies on a two-sided accounting entry to maintain the financial information. So financial transactions has equal and opposite effect in at least two different accounts, and it uses the tools debit and credit in recording the transactions. And please note that for every debit, there is at least one credit and vice versa. Also, it is very important to note that total debits should always equal the total credits of your entry. So in the bookkeeping system, there is what we call as a T account, which is just like this. It is literally like the letter T, in which the left side pertains to the debit transactions and the right side is the credit transaction. So each side could either have an increase or decrease depending on the account that is involved. For easier identification of the normal balance of these accounts, the following acronym is used. On the debit, it's DEAL, and on the credit side, it's CLIP. So in short, DEAL, CLIP. DEAL has a normal debit balance, so it is on the left side. Normal debit balance means that the following accounts will increase if it will be debited. DEAL means drawings, expenses, assets, and losses. On the other hand, CLIP means capital, liabilities, income, and profits. So whenever these accounts are credited, it means that it increases. The other hand, these accounts, these four groups, if there is a debit, it means that it will increase. Now that you are already familiar with the normal balances of each account, let's start journalizing transactions in the general ledger. So journalizing is a process of recording the financial transactions in the general journal or the books of original entry. So it uses the chart of accounts in the recording process, and it simply means that it is the list of account titles to be used by the business and the related account number. An example of chart of account is this. So in here you can see all the assets, liabilities, owner's equity, account, and the expenses. These account titles are what's used in the debit and credit recording of business transactions. That's why it's important to familiarize or have a copy of the chart of account. Journal entries have these important components: transaction date or when the transaction happened, debit account from the account titles in your chart of accounts, and then the corresponding amount. Next is the credit account, and then its corresponding amount, and then lastly, the description or explanation of the business transaction. So journal entries can be recorded using a simple entry or compound entry. Simple entry means that the journal entry has only one debit and one credit, while compound entry, the journal entry has at least 2 debits or 2 credits. For example, here is the business transaction. On April 15, 2022, rendered services to Koichi Company for 84,000, receiving a 30% down payment and the balance on account. So in this transaction, since you rendered a service to your client, it means that you will have a service income. But then, there is an additional information here that you have received 30% down payment. So it simply means that 30% of the 84,000 was given to you as cash, and the remaining balance is on account. So first, to record the cash that was paid to you by the client, the entry, if simple entry is used, is you should input the date and then debit cash because you received cash and that is an increase in your cash account. And then since you have a service income, so to increase your service income, it should be credited by just the 30% of the 84,000. So that is 25,200. Next item, you should recognize the balance on the account. So from 84,000 minus the down payment of 25,200, the remaining balance is 58,800, and it will be recorded as debit in accounts receivable for 58,000 and a credit to service income for 58,800. So notice that the debit and credit transaction should always have an equal amount. So that's for the simple entry. Next is for the compound entry. So for the compound entry, it is just a combination of at least 2 or more debits or 2 or more credits. So in this case, we have a total service income of 84,000. So we recognized it as a whole. But then we will divide it into 2 accounts on the debit portion, wherein we will have to recognize the 30% down payment as cash and then 25,200 and accounts receivable of 58,800. So as you can see here, there are 2 debits and just 1 credit. So here are the sample transactions and then the pro forma entries. So you may take a screenshot so you can add this to your note. You can see here the difference between the permanent withdrawal and then the temporary withdrawal in owner's equity. Permanent withdrawal, meaning that the owner does not intend to replace what was withdrawn. That's why it is a direct deduction to your owner's equity account. However, when we say temporary withdrawal, meaning the owner has an intention to replace what was withdrawn. So, it is just a debit to your owner's drawing and then to cash. So for the rest of the examples, you can just pause this video or take a screenshot so that you will know the pro forma entries and the accounts to be debited and credited. So here is another example of journalizing business transactions. Given the following transactions of Sherry Fitness Club, prepare the journal entries for the month of April 2022. 1. Sherry opened her health and fitness center with investments of various exercise equipment worth 745,000 pesos, tables and chairs for the reception area costing 44,000, and various materials and chemical supplies for the spa worth 12,700. Next, Sherry opened a bank account in the name of her business for 25,000 pesos. Third, paid business permits totaling 2,100. Fourth, Hans, a customer, subscribed to the club by paying membership fees of 15,000. 5. Purchased office supplies for 7,000 pesos cash. So let's now create the journal entries related to these transactions. Okay. For number 1 and number 2, the journal entry is So for April 1, so first, exercise equipment worth 745,000. So it's recorded here. And then another for tables and chairs. So it costed 44,000. So tables and chairs are part of your furniture and fixture. So it's recorded here on the second line item for 44,000. Next is the chemical supplies worth 12,700. So in here, you will record the spa supplies, which is also part of your asset, for the amount of 12,700. So all in all, the total of Sherry's capital in the owner's equity equals 801,700. So as you can see here, the debits, all three items, will equal the credit side amounting to 801,700. Next for April 2, so Sherry opened a bank account. So we will record it here as cash. And then another investment of Sherry, so it should be part of her capital. So Sherry capital amounting to 25,000. So there's the date, the debit, and the credit, and the corresponding amounts. For items 3, 4, and 5, here are the entries. For April 3, we paid business permits. So business permits are under taxes and licenses. So these are expenses or your costs. So as previously discussed, expense is part of the deal in which the normal balance is a debit. So to increase your expense, you will debit tax and licenses expenses amounting to 2,100, and since it is said here that it is paid, meaning there is a decrease in your cash, so you will credit cash by 2,100. And then the explanation is to record the payment of business permits. Okay. On April 4, so Hans, a customer, subscribed to the club. So it paid, okay? It paid meaning you received a cash amounting to 15,000. So since cash is an asset, the normal balance is debit. So the entry is a debit to your cash and then a credit to your membership fees or your service income amounting to 15,000. Next, you purchased office supplies for 7,000 and it is paid in cash. So meaning it is still a decrease in your cash, which means you have to credit your cash account. Okay. And since you received a supply which is part of your asset, you will debit office supplies and then the corresponding amount is 7,000. Journalizing process is really just about analyzing the business transaction, identifying the correct account titles, and recording the correct amount involved. Now let's proceed with step 3, which is posting to the general ledger. This is the process of transferring the debit and credit amounts in the general journal to the appropriate ledger accounts or T accounts. So the ledger accounts are placed in a financial book that is called General Ledger or Book of Final Entry. So once the posting to the general ledger is done, always remember that cross-referencing is made by indicating the account number back to the general journal. So let's now proceed with our example in here. So you can see here again the chart of accounts where you can see all the assets, liabilities, owner's equity, income, and expense account. Okay. So you can see here just a sample of the T accounts or the general ledger accounts. So here is an example for exercise equipment, Sherry capital, and then cash. What's done here is just to post all your journal entries from your general journal into the correct or the appropriate general ledger accounts. So this side here are the general ledger accounts. So for example, in exercise equipment, so in here, there is a debit amounting to 745,000. So we will record it here on April 1 and then the corresponding amount. So as you can see on the transactions or the journal entries, there is no other entries that involves this account. So let's now proceed with the second general journal, which is Sherry capital. In our previous example, Sherry Capital was credited here in General Journal number 1 and then General Journal number 2. So you can see here that there is a credit on April 1 amounting to 801,700, another on April 2 which amounted to 25,000. So let's now proceed to the third account, which is cash. As you can see in our previous example in the General Journal, cash was recorded several times. So on April 2, there was a debit entry amounting to 25,000. So we will post that on our General Ledger, which is in here. And it should be on the left side because it is debit. Next, there was an entry on April 3. So it is now credit amounting to 2,100. You will post it on the right side since it is a credit. Okay. Next, on April 4, there is a debit in cash amounting to 15,000. And then you will post it again here on the debit portion. And then lastly, on April 5, there is a credit entry amounting to 7,000. So during the end of the month, you will have to total the debit portion and then all the credit portion. In order to get the ending balance of cash, you will have to subtract the credit portion from the debit portion. So 40,000 minus 9,100 is equal to 30,900, which is your ending balance.
The same process is also done for the other ledger accounts.
Again, these three accounts are just examples. All the other accounts such as furniture and fixtures, spa supplies, tax and licenses expenses, service income, and office supplies have another or a different T account. So that's for the posting of General Journal to the General Ledger. Let's now proceed to the trial balance. So this refers to just the summary of all the balances that was in our ledger accounts. So all the total debits minus all the total credits, so that's the balance. And once you have all the balances from the general ledgers, you will make a summary of these balances in what we call as trial balance. So in trial balance, all accounts are arranged in the following order. First, assets, then liabilities, then equity, followed by income, and then expenses. You can see here a sample of trial balance from Quest Company dated January 31, 2016. You can see here all the account titles from the asset, which is from cash up to furniture and fixtures, and then liabilities, the accounts payable and unearned income. Equity is from Richard Capital and then Richard Drawing, service income, and then the expenses from salary expenses to interest expenses. So in trial balance, you can check whether the account titles here have normal balances. Deal clip is applicable here. So for the asset portion, the normal balance should be debit, okay, from cash to furniture. And therefore, the liabilities, it should be credit as well as the capital account. And then the drawing account should be debit. Income, on the other hand, is credit. And then all the expenses account has a normal balance of debit. So once you have all these balances, you'll have to add all the debit balances and then all the credit balances. Wherein our expectation is that total debit balances should equal the total credit balances.
So that ends our topic today. Thank you everyone for listening, and I hope you learned something today. Goodbye!